So in this video, I'm going to show you how you can invest as a teenager. I'll show you what accounts you can use, your best investment options, and some things to consider as a teenage investor. Remember, I am not a financial advisor, so please do your own research. One of the world's most successful investors, Warren Buffett, once shared what he called the snowball effect to explain why investing at an early age can increase the odds of becoming a wealthy adult.
Say, make money, money, make money, money, money.
This analogy refers to how a small snowball, of course that would be considered your small initial deposit, can become a big one as long as you let it roll down the hill for a long period of time. The longer it keeps rolling, the bigger it gets, and this is the main reason why you should start investing in the markets, even if you are just a teenager. Imagine you open an account with just $500 when you're about 12 years old and invest that money in an index fund tracking the S&P 500. If you do that single $500 investment, by the time you are 35 years old, that's how old I am, you'll have around $4,478 if the index behaves similarly as it has in the past 50 years or so. Now, if you add money to the account every month, even just a tiny bit, that figure can grow even larger, and you could end up even having enough money for something like a down payment on a house if you're disciplined enough to let your money sit there for that long, while reinvesting the proceeds you get in the form of dividends. Sorry, I'm getting a little excited about this. Let's talk about a couple things you need to understand when investing. First, how old do you have to be to invest in stocks? When you are a teenager, you can't just go to a brokerage and open an account by yourself because the law states that you must be at least 18 years old to do so. However, your parents can actually open an account for you and act as custodians of that account. Can you make decisions in regards to the investments you want to make even if your parents opened the account? The answer is sure. You can talk to your parents and negotiate an arrangement in which they will let you manage the money they have deposited into your account. And you can use the online trading platform provided by your brokerage firm to execute your transactions. Now, as long as you have their permission, you can manage the money held within the account to learn about the ins and outs of stock investing and trading. Now let's talk about investing accounts. Not all investment accounts available for teenagers are created equal. Some of these accounts are open for a specific purpose, such as maybe saving for college, while others limit the type of instruments you can actually invest in. Let me give you a brief overview of the types of accounts available, at the moment for teenagers in the US. First, there are custodial account options with UGMAs or UTMAs. This tax-advantaged account is opened with an initial after-tax contribution from a parent or any other adult. All the assets within the account belong to the child, but are transferred to them only once they have reached a certain age, which is usually 18 in most states. The first $1,100 contributed to the account in a given year are actually tax-free, while the next $1,100 are taxed at the child's tax rate, which can go as low as 0 in some cases. Any further contributions are taxed at the adult's regular rate, and there are no contribution limits for UGMA or UTMA accounts. Balance of the account can be invested in any instrument made available by the brokerage firm, and withdrawals are permitted as long as they are made for the benefit of the child, maybe something like paying for their college education. Now, one other thing that is important to note is that since UGMA and UTMA's accounts are considered an asset owned by the child, they typically count against financial aid. Next is a 529 education savings plan. 529 account is specifically intended to finance a child's college tuition and college-related expenses, and parents can use it as a tax-advantaged vehicle to save money for this stage of their kid's life. These accounts are going to allow the beneficiary to either purchase units of credit at participating colleges and can be also used as an education savings plan. This second option is the most popular, and it involves investing the contributions made to the account into different financial instruments, including things like mutual funds and exchange traded funds. Since the money is intended to be used to pay for a child's college expenses, Withdrawals are typically limited and can only be made for this purpose, or else a penalty and corresponding taxes will have to be paid. Now, meanwhile, as long as the money remains in the account, no taxes have to be paid on the earnings the investments generate. Finally, parents can contribute as much as $75,000 per year or $150,000 for married couples into that 529 account. Now let's talk about IRA accounts. A custodial individual retirement IRA and custodial Roth IRA accounts are tax-advantaged accounts that parents can open for their kids to help them save for retirement from an early age. These accounts work similarly to a traditional IRA opened by an adult, with the added benefit that due to the longer investment horizon, the impact of compounding will be larger and could possibly increase the net amount saved once the kid reaches retirement age. Similar to regular retirement accounts, early withdrawals are subject to penalties and taxes unless they are made to pay for educational expenditures. The assets held within the account are considered part of the kid's net worth, and they must be transferred to them once they reach the age typically between 18 and 21 years old, depending on the state. A Coverdell account is another way of saving for college through a tax-advantaged account, although the specifics of how this account works are a bit different from other alternatives, such as 529s. For one, there is a contribution limit of $2,000 per year per contributor. Now, that said, parents can apply for super funding through Form 709 to be able to contribute up to 5 years in contributions while avoiding gift taxes. On the other hand, parents with a net combined income that exceeds $220,000 are not eligible for this type of account. Now, one benefit of Coverdell accounts is that they are more flexible when it comes to withdrawals, as parents can opt to use the funds to pay for non-tuition qualified expenses, including books, supplies, uniforms. These withdrawals apply not just to college expenses, but also elementary and secondary school. Keep in mind that the money you hold in a Coverdell account can be used to pay for a number of expenses for kids attending primary, secondary, and higher education schools. We talked about some different types of accounts to invest in. Now let's talk about your options within the account, and these options are in no particular order. First, you can invest in stocks. Now, this will not be your safest option, but it's good to know about them. Stock is a financial instrument that gives the holder ownership over a certain percentage of a company's assets. They are considered a variable income asset class, as the largest portion of the returns obtained come in the form of price appreciation, known as capital gains. Now, that said, certain companies also issue dividends, which are fixed payments distributed to shareholders based on the percentage of the company they own. Now, on the other hand, by owning a stock, a holder can vote on crucial decisions about the company's future by exercising his or her voting rights during the annual shareholders meeting. Second, you can invest in mutual funds. A mutual fund is a vehicle that invests in different asset classes following a predefined scope and strategy, and they are managed by investment professionals and offered by reputable institutions, including bank and financial services companies. The main difference between mutual funds and ETFs, which we will talk about in a second, is their liquidity, as mutual funds often impose limitations in the minimum holding period required before a withdrawal can be made. Nowadays, amid the rise of low-cost ETFs, mutual funds have been forced to slash their expense ratios, management fees, and other related costs to really keep attracting investors. Some of the asset classes covered by mutual funds include fixed income securities, equities, precious metals, and active strategies that focus on certain types of companies or sectors of the economy. Then there's an exchange-traded fund, otherwise known as an ETF, which works similarly to a mutual fund, but with the added advantage that the instrument can be easily bought and sold as if it were a stock with zero penalties or costs involved in the process. Meanwhile, most providers nowadays offer the possibility of trading ETFs for free. However, these funds usually charge an annual expense expressed as a percentage of the amount invested. Through ETFs, investors can get exposure to a wide variety of asset classes, markets, geographies, and industries that make them a great choice for building a diversified investment portfolio for your custodial account. Next, you can invest in bonds, which are a fixed income security that entitles the holder to receive a periodical interest payment in compensation for extending a loan to the issuer. The interest rate paid by the issuer varies depending on its creditworthiness, while bonds can have different maturities. Based on the maturity dates or when you can get that money out, bonds can be classified as short-term, mid-term, or long-term, and depending on the nature of the issuer, they are typically classified as government, municipal, corporate, sovereign, and GSE bonds. Next is to open up a high-yield savings account. Although this may not be considered an investment, it's always a good idea to have uninvested cash in this type of an account. Savings account is an instrument offered by a financial institution that is typically considered the safest investment alternative, as they are protected by the Federal Deposit Insurance Corporation, otherwise known as the FDIC. Although most savings accounts nowadays offer a low yield due to the current interest rate environment, there are still certain providers that offer high-yield savings instruments. With a savings account, the holder is entitled to receive a periodical interest payment, typically monthly, that is calculated based on the average daily or monthly closing balance, that's usually held within the account. Account holders can either choose to maintain that interest within the account to enjoy the benefits of compounding, or they can withdraw it at any given point in time. A certificate of deposit, otherwise known as a CD, is a banking product similar to a savings account through which a teen can earn interest from their savings. The key difference is that CDs require you to keep your money in the account for a specific period of months or even years to earn the promised interest rate. Then, when you redeem the CD at maturity, you'll get your money back in addition to interest you earned. Like savings accounts, CDs are considered risk-free investments because the money is insured by the FDIC up to $250,000. The downside, however, is that your money is essentially locked up for a period of time. Now let's talk about some specific things to consider as a teenage investor. First is using micro-investing apps. Financial technology companies nowadays have launched multiple micro-investing and savings products that allow retail investors to progressively build emergency funds or even a retirement account by automatically transferring the spare change left when an expense is made. One of these companies is Acorns, an automated passive investing platform that is considered a one-stop shop for all things money management, as investors can open savings, retirement, and taxable investment accounts with this provider. Using fractional shares, Acorns allows investors to buy fractions of a stock with as little as $1 to progressively build their investment portfolios without the need for a big initial deposit. Then there's an opportunity to use a Robo-Advisor. Robo-Advisor is a system that relies on algorithms to build broadly diversified investment portfolios for investors based on their financial goals, risk tolerance, income, employment situation, and other factors, effectively relieving them from the burden of having to do all the heavy lifting. Many brokerage firms have introduced robo-advisors to their portfolio of investment solutions using low-cost exchange-traded funds, ETFs, to build those portfolios in a manner of minutes while charging relatively low fees to perform the service. If you're a teenager who doesn't know much about investing, companies like Betterment offer these portfolio and autopilot solutions that you can rely on to deposit the money you have received from your parents and relatives for your college education and future. Lastly, you want to consider fractional share investing. Fractional shares, as I've already mentioned, are a low-cost alternative for investors who lack a large account balance, allowing them to build a broadly diversified portfolio of multiple stocks and ETFs with as little as $1 per instrument. Public.com is one of those providers currently offering these innovative instruments, while the company has also created a social investing ecosystem through which investors can exchange ideas, chat, and enrich each other by sharing insightful opinions and analysis about the stocks and ETFs they are currently investing in. Public does not charge any commissions for trading these instruments, and that makes it a great alternative for teenagers who might be seeking to build an investment portfolio from scratch. Phew, stay with me. Let's talk about taxes. How do taxes work for teen investors? Although most of the accounts currently offered to teenagers are tax deferred, You should know that in case you withdraw money from it, you will probably have to pay taxes on the proceeds you obtain from your investments. That said, the rate that applies to teenagers for the first $2,200 in unearned income is lower than that for adults, and this rate is known as the kiddie tax, which applies to individuals under 19 years old or to full-time students whose age is between 19 to 23 years old. For the first $1,100 of unearned income, the marginal income tax rate applies, while the next $1,100 will be taxed at the kiddie rate, which can be as low as 0% in some cases. Any other contributions are taxed at the regular income rate applicable to the parent or guardian. Now, I know I've thrown a lot of information at you, and if you're still listening, you're on the right track because you're still here. Starting your investment journey at an early age will allow you to compound your earnings for a longer period, and this will have a dramatic impact on your net worth once you become an adult. Even though some of the accounts offered for teenagers nowadays focus mostly on saving or investing to pay for your college expenditures, others can be used as a vehicle to just build wealth. If you want more specifics on what companies to look into specifically for your needs, please drop a comment below and we can continue the conversation. The other thing is, don't underestimate the power and freedom that wealth can give you to make decisions about what kind of career you would like to pursue or which job you decide to apply for, as having a nest egg can reduce the pressure of having to make decisions based solely on your financial needs, so you can instead pursue what you are most passionate about without having to worry that much about money. I would also be doing you a disservice to not share that investing in yourself is equally important at a young age as investing your money, what little you might actually have at this point in life. Read books, talk to and shadow people who are doing what you want to do, be engaged with your community. These things are also so important. Now, I hope this video does provide some value to you as a teenage investor. If you haven't already done so, smash that like button, drop me a comment below, don't forget to subscribe, and I'll see you in the next video.